So in the world of quantum computing, the future is, well, it's everything, right? But what happens when that shiny future smacks right into the messy reality of today's numbers? That's the story we're digging into with Rigetti Computing's latest earnings call. There's a real disconnect here, and we're going to unpack it.
First things first, let's just get right to it. How did the market react? Well, the stock dropped over 5% on some pretty heavy trading. That's a significant move, and it really sets the stage for everything we're about to talk about. It makes you ask, what did investors see that made them so nervous?
All right, so here's our game plan. We'll start with the headline numbers, the basics. Then we'll get into the real drama, the gap between what management is saying and what the market is actually hearing. After that, we'll dive deep into their tech roadmap, give you our take on what's next, and wrap it all up with a trade idea and the usual disclaimer.
Okay, let's jump into the financials. The numbers that came out really sent a deeply mixed signal, and it's this conflict that defined the whole quarter.
So let's start with the good news, because there was some. Rigetti actually beat expectations on the bottom line. They posted a loss of 3 cents per share, which was a penny better than analysts were calling for. So what that tells you is they're keeping a pretty tight leash on their costs.
But, and this is a big but, that's kind of where the good news stopped. On the revenue side, it was a totally different story. They brought in just under $2 million, a pretty significant miss against expectations. And even worse, that's an 18% drop from this time last year. Ouch. That is the number that really spooked Wall Street.
And if you dig a little deeper, you see their gross margin just fell off a cliff, going from 51% all the way down to 21%. Their operating loss also got a bit wider. But here's the silver lining, and it is a huge one: their cash position. They are sitting on a mountain of cash, about $600 million. That gives them a massive runway to get their long-term plan done.
So this all brings us to the real heart of the issue this quarter. This huge gap between the story management was trying to tell and the reality that the market was trading on.
It's like you've got this split screen thing happening. On one side, you have management on the call talking up all this strong momentum, name-dropping partners like NVIDIA, and reassuring everyone their tech roadmap is on track. But on the other side, you've got investors who are just laser-focused on the here and now. That revenue miss, the year-over-year decline, the shrinking margins. It's a classic story for a pre-commercial tech company, really, trying to sell the dream while the current numbers look rough.
So you're probably thinking, okay, with financials that shaky, why would anyone invest in this company? Well, the answer, the entire bull case, is wrapped up in their technology roadmap. To really get Rigetti, you have to look past the noisy quarter and focus on the long-term vision.
And let me tell you, this vision is incredibly ambitious. They're gunning for a 100-plus qubit system by the end of this year, then scaling all the way up to over 1,000 qubits by 2027. Now that is a massive leap, and it gets them awfully close to what everyone in this space is chasing: quantum advantage. That's the holy grail, right? The point where a quantum computer can solve problems that are basically impossible for today's supercomputers. Now, they still have to improve their accuracy to get all the way there, but hitting these qubit targets would be a total game changer for the stock.
So you gotta ask, how are they planning to pull this off? Well, their secret weapon is something they call a chiplet-based approach. The CEO was pretty clear about this on the call. Instead of trying to build one single, gigantic, ridiculously complex quantum processor, they're building smaller, high-quality ones and then linking them together. Think of it like building with Legos. It's a super clever way to scale up your qubit count without sacrificing quality. This is the core of their tech strategy, and it's what you're really betting on if you're an investor.
Okay, so we've got the weak financials on one side and this really powerful technical vision on the other. Let's put all that together and translate it into a forward-looking view. What should we actually expect from here?
So what's the bottom line here? It really comes down to one simple question. Do you bet on the shaky present, or do you bet on that incredibly promising future? Here's how we see it playing out. First, for next quarter's results, don't expect any miracles on the revenue side. It's going to be lumpy, it's going to be unpredictable. The only thing that will really matter is their progress on those tech goals for the end of the year. Second, the stock price. Get ready for a roller coaster. This thing is going to swing on any scrap of news about their technology, not their financials. And all of that brings us to our final rating.
We are initiating coverage with a market perform rating. Look, that long-term roadmap is incredibly compelling, and that huge cash pile gives them a serious safety net. But the near-term business uncertainty and the unpredictable revenue just keep us from being more aggressive with an outperform rating right now. The risk and the reward just feel pretty balanced at the moment.
Okay, to wrap things up, let's turn all this analysis into a concrete trade idea. And then, of course, we'll finish with our standard disclaimer. So how do you trade a stock like this? Well, listen,
It is not about trying to predict the next earnings report. That's a fool's game here. It's about betting on their technology to actually pan out in the long run.
So here's our trade idea. The thesis is pretty simple. We think the stock will probably drift sideways or even down on financial news, but it could absolutely pop on any good news about their tech. So instead of buy the stock outright, you could consider something like a long-dated call spread. It's just a way of betting the stock will go up over the next year or so, but in a way that limits your risk. It lets you get exposure to that big tech catalyst without betting the whole farm, and it gives their story plenty of time to play out.
And finally, you know the drill. Our lawyers want us to be crystal clear. This is not financial advice. We're just here to break down the moving pieces and give you our take. Always do your own research before making any investment decisions.